Welcome everyone to today's discussion. My name is Brooke Davies. I'm the Legal Markets and Operations Officer at CarbonPool, and I'll be your moderator for the panel today. To give just a brief word of context and framing, so this webinar is a follow-up to a white paper co-written by EY and CarbonPool, which sought to answer the question, as the carbon market matures from a tool from voluntary corporate action to one that is regulated and invested in and made bankable, how then should the assets at the core of this market be treated? And that may seem like a fairly specific question, but it has big implications for whether and how this market will be able to attract the investment it needs to scale and meet our global net zero goals. So that is exactly what we're going to talk about today with our excellent panel of experts and practitioners. We're going to walk through how carbon is being treated as an emerging asset class, the tools that are being built to risk manage that asset, including insurance, and why that's important to attracting financing. And then we'll leave some time at the end of the webinar for questions. And please feel free to use the Q&A function you should see at the bottom of your screen, and I'll try to get to them as many of them as possible. So without further ado, I will introduce our panel. Philippe unfortunately cannot join today due to a personal impediment, but from EY, we have JF Gagnon, partner and sustainable finance lead at EY in Canada. We have Jan-Hendrik van Lengerich, senior manager at EY. From CarbonPool, we have Frederic Olbert, CFO and co-founder. And from Volkswagen ClimatePartner, we have Jacob Bourgeois, head of carbon strategies and innovation. So Jan, I want to start off with you, just to give us some initial framing. How should we be thinking about carbon as an emerging asset class, from the classification, accounting, and valuation of these assets to any changes in standards that you see on the horizon?
Yeah, Brooke, thank you very much for this, and perfect pronunciation on the name, by the way. Not many people get that right. I want to start by saying that viewing carbon as an emerging asset class isn't just a branding exercise. It really is a key for a market that needs to grow from currently a few billion US dollars to about $1 trillion per year if we're really serious about our climate targets. So why does carbon or carbon credits behave like an asset? It grants a transferable right over 1 ton of CO2 equivalent. You can hold it, trade it, retire it to match your own emissions. It serves 3 economic purposes: offset today, hedge tomorrow's liabilities, or speculate for profit, similar to the way firms use metals or energy contracts. But how would we file this thing in a chart of accounts? Well, right now, there is no dedicated accounting standard under standards like IFRS or US GAAP. So we have to borrow existing categories that were never really designed for environmental credits, and where the answer really changes with your purpose. You can think of it as 4 common areas. One is the immediate offset. You buy a credit today, retire it immediately, so you would expense it generally. 2, hold it for later targets. You would treat it as an intangible asset or inventory. Therefore, you would need to test it for impairment if prices go south. 3, you would trade it for margin, hold it as an inventory at low cost of market, or possibly fair value through profit or loss if you run a trading desk. And then 4 would be the insurance piece of this. If you're running an insurance, you would be using carbon as an asset to settle claims. Whichever way you're going, the golden rule is that classification always depends on specific facts and circumstances, the intent, holding period, and how the contract is written. On the valuation side of things, it's more trickier. With thin trading in many project types, observable prices are scarce. Most companies can carry credits at cost and test for impairment using a variety of things, including but not limited to broker quotes, recent transactions, model curves, or internal models, or a combination of those. Nature-based credit there gets a little bit more scrutiny because storms or fires can wipe out the underlying forest. And then structured offtake deals often need to be split into their individual parts so you don't mix apples and oranges. On the side of the standard setters, the IASB project on climate-related uncertainty hints at how existing IFRS can be refined in that area. In the US, the FASB is a bit further with that draft topic 818, which would treat environmental credits at cost and derecognize on use or sale. Whichever way the debate is going, cost, fair value, and so forth, you would typically want to build your systems that can switch models without a complete rebuild. So in essence, 4 practical tips that we have for finance teams. 1, start with strategy, not spreadsheets. Your accounting treatment flows from whether you plan to offset, hedge, or trade. 2, map the credit's life cycle. Where do you recognize it? How do you measure it? When do you retire it or sell it? 3, you want to build a defendable price curve. Even if you carry that cost, you still need to need some market intel for impairment tests and disclosures potentially. And then 4, finally, you need to document your judgment. Auditors will want to see the reasoning on classification and valuation. Yeah. So to wrap it up, always consider the individual facts and circumstances. And well, if in doubt, you can always call your friendly accountant and consult with them.
Perfect. Thank you. An excellent overview. We appreciate it. JF, with all that context in mind, I'd love to turn now to kind of the investment perspective and side of things, since this is so much about how do we get capital off of the sidelines. How are institutional investors approaching carbon as an asset?
Thanks, Brooke. But I think carbon is an investment play right now that's mostly for those guided by a green mission. Either they aim at decarbonizing their portfolio, or they're seeking to drive impact by enabling energy transition or creating nature financing opportunities, and that they can claim that impact. So specifically, it's difficult for large institutional investors to make nature plays, right? First, mostly because size matters. And it's much work to invest $50 million into a nature project, for example, and it's just as much work to invest 500 million. And so when you have a 250 plus billion portfolio, which a lot of those interested in these plays are, 50 million is not even moving the needle, but taking a lot of resources internally. So it makes it difficult for it to become a dedicated asset class in itself, and then have the talent that understands the dynamics, the environment, and can do a proper due diligence around it. The second element that makes it difficult for them is that because getting the concessional capital to de-risk some of those projects is a lot of work and often requires multiple players to be involved with potentially different impact stories that they want to be telling. The third one is that the best growth rates are often in emerging countries, and large institutional investors are less familiar with those markets. So for example, when you think about an African-based project, you must find investors at the convergence of being comfortable with the African market. Right there, you've lost a lot of institutional investors. Having and being able to work with a developer that has a track record, that knows how to operate not only within the African market, but that can partner properly with the communities. You need to have someone that understands and can complete a due diligence on a nature-based project. And finally, that can develop the proper risk-return profile by leveraging both insurance and catalytic capital. So it's an intersection that is quite small of investors that can play in that realm. Finally, in the fourth one, so most players do demand at the onset to have off-takers already jump in these projects. That being said, and those are the impediments, and I think as an industry, we're really good to explain why things are not working, but I didn't come here to tell you it's all gloom and doom. There's a lot of positive elements on the horizon. And the first one is that the orthogonality of the performance of those projects to the stock market is very appealing, will not go away. And by definition, those projects enrich an investor's portfolio's risk-return profile. And that's very difficult to ignore. Those playing within the nature space are access to IRRs, and they won't mention that too much, but there are that are in the 20% plus. Project that we're supporting the capital stack right now of reforestation in Ghana has an IRR of 24%. There will be announcement soon of a global catalytic platform of professional fund investors that will come in to assess these projects, build a diversified portfolio of projects, and provide the confidence to large institutional investors that don't have these capabilities that the money that they aim to deploy is done in a professional manner. And that's going to come very soon, but I think it's probably the worst kept secret right now within our industry. There is, and thanks in part to CarbonPool, a much better span of offering when it comes to insurance to de-risk projects according to the sponsor's risk appetite. There's an increase in interest in private deals where high quality and high integrity credits are created. So before, a lot of organizations would just go to registries. Nowadays, they seek high integrity, high quality credits, and that means understanding the deals that you're getting into. In fact, some ultra-savvy investors are playing both the off-taker and the investor role. Think, for example, of being an insurer. You have your carbon commitments, decarbonization commitments. If you have the general account team looking at very tantalizing deals that are providing a lot of value from an investment perspective, you can leverage the corporate office and say, we've done the due diligence. This is a great deal. For us from the general account, we need an off-taker on the project. And so the corporate abides by its commitments while the general account improves the risk-return profile with very nice investment returns. So in conclusion, and your question, will it become, is it a true asset class within the next 5 years? Not on its own within large institutional investors in the classic definition of an asset class like private credit or real estate. Over the long term, I believe it will. As the carbon market moves to 1.5 trillion by 2050, which would compare very well to the size of the oil market today, which is 2 trillion annually, I think there's a big chance that this becomes a recognized asset class with dedicated talent pools within institutional investors. In the meantime, I think it will become a new offering for asset managers because it's a great way to improve the access to the investment universe and have your clients diversify their risk return profile.
Yeah, great. Thank you. And very exciting kind of insights to end on there, JF. I appreciate it. And what I'm hearing from you is that, there are certainly many challenges on the road to carbon really becoming a kind of mature asset class in its own right? You've got the size of the opportunity, the complexity and structuring. You've got, the need to get more comfortable with project idiosyncrasies. And then you've got the needs for, strong demand signals and offtakes. But you've also got some very exciting opportunities to scale if we can get certain fundamentals right? Including risk management, which is where I'd love to turn to next and bring in your perspective, Jacob, from Volkswagen ClimatePartner. And I'd love for you to kind of give us a practical case study as someone who sits between the corporate and the developer perspective. Give us a range and a view of the biggest risks that you see to the carbon assets on your balance sheet.
Yeah, sure. And thanks for the invitation. Apologies, I have a little bit of a cough today, so hopefully I'm clear when I'm speaking. Right. So, I represent Volkswagen ClimatePartner. Just to be clear about where we sit within the investment space, because I think we're getting different perspectives on the kinds of investors into this. We're a joint venture co-owned by ClimatePartner and a member of the Volkswagen Group. We were essentially set up as an investment facility and quality control facility, gatekeeper, if you like to say, for projects that would be intended for end use by either of our two shareholders. At the moment, currently, that's primarily the Volkswagen Group. So we're not actually interested in investing in these really as an asset class in the sense of seeking a financial return. We simply invest in projects. We provide upfront capital. We manage portfolios of projects that have a specific flow and kind of expected issuance of credits over time, and we retire these more or less immediately. That's really what we were set up to do. So I think in thinking about risks, I understand the perspective that long term this may turn into a kind of investment asset class of some kind. At the moment, it's still quite immature. We have this very specific use case that we apply, and so the risks that we face are quite significant. And I mean, as one of the larger buyers in the market, we're very aware of those, I think. So yeah, running through them kind of one by one, one of the larger risks that we would face would be purely financial. I mean, that's very obvious. So managing liquidity risk over time, as I mentioned, we are an investment facility, but liquidity is limited. We can only apply so much to each individual project. How much we apply varies by the project. Some need more pre-investment, some need less. And we basically have to manage our liquidity and make sure that it's sufficient to cover the investments that we need to cover for the projects we need to cover, and that we return this, we get this money back in the form of credits that we're compensated for over long periods of time. And obviously, when you're dealing with different kinds of projects, especially removals, nature-based, as we know now, are at the higher end of the investment spectrum, we can say, and the slower on the return side. That has to be managed very, very carefully. And of course, looking at counterparty risk, kind of country that you're existing in, all these sorts of things, that all plays into that. The other would be delivery risk. This is also a very obvious one, especially with our clients. We deal with contracts that deal with very specific quantities of credits. Sometimes they have to be delivered in a very precise manner, even quarterly sometimes. That's very challenging to do. I mean, one, in case of project failure, that's one thing to consider, but the other would be, as we know, the standards themselves face delays. They have their own challenges. It's not always easy to deal with that. You have various auditing schedules. And when you're managing many, many projects like that, I mean, you sort of have to plan in a certain amount of overcapacity to compensate for the fact that probably you're not going to get the credits when you need them on time and in the quantity that you wanted. So that's another risk that needs to be managed very carefully. I mean, on top of this, it would be various kinds of risks that I think would really affect the investment that you want to make. There's obviously political and regulatory risks, both in terms of laws on the ground, kind of land title issues, social conflicts, likelihoods of getting sued, and so on and so forth. But of course, Article 6 and dealing with that sort of thing, if you want to label your credits under the Article 6 scheme or CORSIA or whatever the case would be, those are often political decisions. They move slowly. There's a lot of turmoil in the world, and that's also quite difficult to manage. Pricing risk, of course, is tough. If you're doing investments, you're pricing in at certain currencies. There's currency fluctuations. This can all affect project performance, also the returns you get. Also, if you have, depending on the commercial arrangement, a payment on delivery or other kind of compensation mechanism, then that needs to be factored in. There's post-issuance risk. This was also mentioned. So likelihood of credit invalidation, reversal, force majeure risk, things like this. The classical kind of contractual stuff, abandonment and insolvency on the part of the counterparty. I mean, that would also need to be taken into account. There could be carbon cancellation issues with buffer pools with the various registries. That's also very important. And then kind of smoothing finance over time, which has to be managed between end buyers, ourselves, and the credit originators. It's all very complex, and it has to factor into our investment decisions. And on top of that, I mean, I think maybe not so talked about as much, but I think it's very relevant for the market, generally speaking, at least over the last years, would be reputational risk. I mean, so there's brand damage that could come up, various compliance issues, or if you're investing into a project that has a majority shareholder with an unsavory background, let's say, or kind of other issues with following the law, especially in challenging countries, which is where a lot of these projects are implemented. These could all lead to financial losses that has to be considered as well.
Yeah, thank you for that list. I think my blood pressure rose with each new one you added to the list. And I think just hammers home that, we talk a lot as well on kind of the difficulties of developing projects and investing projects, but from the buyer perspective as well, you're in the trenches with us and facing, a lot of potential losses. And I think what really underscores for me as well is that, all of this together, counterparty risk, political risk, permanence risk, reputational risk, right? All of this together, I think, creates a general uncertainty, right? If you're a buyer, you don't know the credits that you're going to get, the quantity of them. You don't know if they're going to remain permanent. You don't know if one day there's going to be an article coming out that causes reputational damage, right? If you're a developer, you don't know if you can't deliver the number of credits that you thought you could. You're not sure of the returns that you're going to get, returns that potentially the communities that you work with are relying on, right? And then as well, if you're an investor, you're not sure if the returns that you've projected are going to be the ones that you get. And I think with all of that uncertainty, it is hard for this market view to scale, right? It's hard to build efficiencies. It's hard to give comfort, right, to investors and also to potential buyers who are looking and saying, wow, I really want to make this a part of my sustainability strategy, but look at all of this uncertainty in the market. Can I really do this? And so with that, I'd love to turn to you, Frederic, and to talk a little bit about, what are the range of emerging risk management tools that are now coming online when sourcing from or developing a project that can help mitigate some of this uncertainty that Jacob just laid out.
Thank you, Brooke, and thank you, Jacob, for a very extensive, but I think much needed list. It shows the battle scars and the experience of those that are actually out there putting capital at risk and at quite considerable scale. So very much appreciate that. And I'd like to kind of expand and embed the risk thinking on the individual project level to what kind of risk management tools do we have today? And what is the framework, at least at CarbonPool, that we use to think about this on a more macro level? And I hope many of you will find this helpful. So we usually go from individual projects to then thinking about a portfolio of projects and then looking at what are the outcomes I'm solving for. So what does that mean? So on the individual level, the risk management tools are essentially what Jacob outlined, really going through the list of individual risks that a project is facing, assessing those sometimes with in-house resources. Sometimes it's very good. There are very good external resources out there that can help. One layer that we like to add and that we hope the market will start taking on more and more is really thinking of these risks in a more quantitative fashion and actually risk modeling projects, as in what are the risks that my project is facing? What are the probabilities that something might go wrong? If something goes wrong, how big is it? We at CarbonPool, we actually use a similar metric that you would use from a portfolio management perspective in financial markets, where you look at your value at risk, as in what is the 1% worse outcomes, and how big is that worse outcome? We call it carbon at risk, as in the 1% worst cases, how big is it? And it's very helpful to have a metric like that, because risk is not just what is the probability that something goes wrong, it's also how bad is it when it happens. Then the next step of what we do is to actually build a portfolio. And as a lot of the financial sages say, diversification is the only free lunch there is in the world. And this is something that applies to carbon as well. And there the question is, how do I assemble a carbon portfolio where I invest into multiple projects, and what do my risks actually look like now on accumulated basis? Usually much better, because projects don't tend to be correlated. So that's an additional layer of risk management that I get essentially for free, but it obviously comes at the cost of having to invest into more projects. there are more and more providers out there, like Rubicon, who unfortunately couldn't join, that are looking at carbon portfolios and building portfolios that you can actually buy as an end buyer. So that's a risk management solution you have there. And also on the rating side, B0, for example, has built a portfolio ratings tool that allows you to take your different projects, add them up, get individual ratings for each project, but then also have accumulated rating that is usually better than the individual ratings of each project, because now it's diversified, and on a diversified basis, it looks much better. Then there are two more layers that we like to look at. One is very technological, as in what kind of monitoring tools and MRV can be implemented so that you understand at least a lot of the natural risks of your projects as they unravel. Part of risk management is also knowing what happened, know what's going on, and then being able to adjust. And then finally, insurance. And we'll go into that much more in depth. But the beauty of insurance is it's your last line of protection after you've gone through individual due diligence, after you've gone through diversification, understanding what your portfolio looks like, and after looking at how can I monitor this over time. And even with all of those steps, the risks are still considerable. And the statistic I like to quote is when drivers are interviewed, 8 out of 10 drivers say that they are above average drivers, and 1% of drivers say, only 1% say they're below average. And that's just a human tendency that we don't like to think about the things that can go wrong, but that's what we're then ultimately for. They're therefore to take those risks that you can't diversify away and that are still there and that will still keep you up at night.
Excellent. A scary but insightful perspective, Frederic. Thank you very much. JF, I would love to turn it to you. And actually, Frederic, you teed us up beautifully to really double click on insurance as a risk management tool. JF, from your perspective and from an investor perspective, what is the power of insurance and why is it an attractive proposition to kind of plug into this market when thinking from that investment perspective?
I think there are two main pillars that are quite different here in this market. One of it is insurance, and I'll go a little bit beyond your question at the end, but insurance plays a massive enablement role. I mean, it's true that for all infrastructure projects, and most of these projects, including carbon capture projects, are often infrastructure projects. So be it protecting against reversals or guaranteeing production or political risks, there's different types of insurances that are available that are key. And what we've seen in working with investors is that projects are enabled once the risk aspect is managed. I remember 15 years ago, I was building an insurance-linked security asset manager, and we had a risk pool, and we could change the risk pool. And what we told the investor who was looking to invest $1 billion into that risk pool was, we can strip out the Florida risk, or we can keep it in. And the Florida risk by itself will yield you over 10 years, 40% CAGR. And they were like, oh, we love this. Yes, but 1 year you will lose 80% of your capital. They would not touch this with a 12-foot pole. And so what we're seeing here is that the ability to take an IRR that's 20% and reducing it to 15%, but making the investor comfortable leveraging insurance in some aspects and then blended finance in some others in terms of the risks that they're undertaking is absolutely critical to be able to bring about these projects and get the right financing. So this is why when we look at our projects, we sit down with the anchor investors, we outlay all the risks that are present and how to mitigate them. Obviously, their first reaction is, well, let's get rid of all of these. And we say, yeah, sure. So the IRR just gone from 24% to 7 or 8%, almost the risk-free rate. They're like, well, no, I don't want to do that. And this is where the discussion in terms of where their comfort lies is important. But without having insurance, a lot of the key risks would be very difficult to remove and bring the investor interest. A little bit as a parallel to this pillar, and I'll do this fast, Brooke. I think the other key pillar here is for those who are playing in this field, going beyond the motion of just doing. When you have carbon as an integral part of your strategy, it allows you to clearly claim impact in terms of the jobs that you've creating. A project I'm working on, it's 5,000 new jobs, and let it contribute to your market differentiation. What we're sensing in the market, and it's very early days, is that people are willing to go against a market differentiator player that really brings about a better new world. So I think when you have the insurance pillar to manage the risk, but also the strategic fit versus just going through the motion, I think you have something that's very potent.
Yeah, I think you touched on something super important here, JF, which is that, as insurance is kind of a new entrant into the market, a lot of what we hear from developers and others is like, this is one more cost item, right? This is one more thing I'm going to have to build into my financial model. This is one more thing that's going to eat into my margin, right? But I think in all other industries, insurance is seen as not a cost, but an enabler, right? It's not about cutting into the financing metrics. It's about making the financing metrics even possible in the first place, and really unlocking this finance. And I think that's a reframe that's happening, but I think you put it extremely eloquently, and I appreciate you really bringing that perspective. Jacob, I would love again to kind of go back from your side, from a buyer perspective. How are you thinking about incorporating this new tool of insurance into your risk management strategy?
Yeah, no, it's a good question. I mean, I think we also see it as an enabler to some extent. I mean, this is something we're still evaluating, of course. It's a new product. I think with all the risks that I mentioned before, not all of those are insurable. There's lots of products on the market. Some I think are more solid. Others I think are more emerging and yeah, potentially even gambling to some extent because risks are still emerging and understanding them is still emerging. But I think for us, yeah, in key critical areas, we also see it as a way to actually do more of what we do. I mean, that's ideally what it is. Particularly in two areas. I mean, for us, out of all those that I mentioned, I think what we're really concerned with for ourselves is really the liquidity management and kind of the pre-investment recovery side of things, and then also the delivery risk, because that's where most of our obligations are with our end client. And as I said, because we don't see these as investments in the sense of getting an IRR out of them, we don't invest equity into projects. We're simply interested in the volumes, really, and being able to invest in more projects. So those are the two critical ones. I think the kind of pre-investment recovery liquidity management is an obvious one. I mean, particularly for certain kinds of projects, as I mentioned before, reforestation, for example, significant pre-investment, long-term outlook in terms of getting your investment back, in terms of liquidity. I mean, and very high risk. I mean, they can fail at quite a high rate depending on the project and the country that you're looking at. I mean, that's really a critical one. Also, in terms of looking for co-financing. I mean, we do a lot of the financing ourselves, which is good because we have full control, but then also is limiting on the other hand, because when we run out of liquidity, we run out of liquidity, and then we can invest in more projects. So kind of having that option to de-risk, I think is helpful on the delivery side as well. Depending on the contractual obligations that we have from a delivery perspective, and as I said, depending on the timelines that we have, it can be quite onerous in terms of getting exactly what we need when we need it, but not wanting to necessarily rely fully on a spot market where prices might be continually increasing. This could be a good risk mitigation for that as well. To maybe, as you said, maybe it is a little bit of a cost item. Maybe you do pay a little bit more than you would under a pure self investment option. But with the risks that do exist, the alternative is simply having to find other supply short notice, and that's a cost as well. So this is a way to kind of mitigate that.
Yeah, absolutely. Okay, great. Thank you. One perspective I want to bring in here as well. We've talked a lot about buyers. We've talked a lot about, I think, equity investors in particular. But I want to bring in the project finance side as well, because I think that's a really important place where insurance can play. Frederic, I know that you've been doing a lot of thinking around how insurance can be used to unlock the project finance side, especially at a larger scale. I'm curious if you can kind of give us an overview of the emerging template for project finance in the carbon market, especially for nature, and how insurance really plays a role and can help unlock that capital.
Thank you, Brooke. I love talking about this, and because it cannot be stressed enough how important it is that we get this to work. Because there's so many flywheel effects here. I mean, JF was mentioning the fact that a lot of very large institutional investors actually want to play in carbon, but they're just not finding opportunities at scale. And then they just run into that problem where they are very willing, the capital is there, but it just cannot be deployed. So it's one of those classic positive flywheels or hen and egg problems where, let's say, the egg needs to be big enough so that we can start laying more eggs. The way we think about this is we work a lot with project financiers, with banks, and one of the key missing ingredients to scaling carbon markets is debt, infrastructure-like funding, where then JF's clients can come in and deploy billions at, say, somewhere between 5 to 12% per annum. And the challenge we're facing there is it boils down to the very fundamental challenge that you have as a lender. And the very fundamental challenge you have as a lender is that you always ask yourself two questions. What's the probability that something will go wrong, that my lender will default? That's my probability of default. And how bad is it when it happens? Like, is there any meaningful collateral I can enforce against, so that even if the project defaults, I can still get some money back? In some markets, that's really easy, right? If you get a mortgage on your house, even if you defaulted on your mortgage, the bank now owns your house, and most of us know that a house has value, and the bank knows that they'll get quite a bit of their principal back. Obviously, that's a terrible thing. It's terrible when that happens, but this is what makes mortgage markets work, the fact that there's something you can enforce against, and there's some real collateral. Now, in carbon, we're struggling with both, or our banking partners struggle with both. They don't know how to assess carbon projects, and they don't know what the probability of default is. And they don't know, or they can't identify any meaningful collateral. On the first question, with insurance, we can help, because now a project that's insured, the probability of default is now the probability of default of the insurance company. And on the collateral side, it can also help significantly, because today there is no meaningful collateral when you look at a carbon project. Especially, let's use a nature-based project as an example. A failed nature restoration with native species has no economic value. It has a lot of ecological value, it has societal value, but you cannot actually take it and sell it and recoup your money. Now, the model we're co-developing with some of the large project developers and also banks that are working on this is to think about, okay, how can we solve these problems? How can we kill two birds with one stone in one single structure that addresses the problem of probability of default and collateral? And the solution we've come up with, and we're working on at quite considerable scale, is to say, okay, let's take projects that already have an offtake agreement. With those, you have a situation where there's a price that has been set by a corporate offtaker like VW or Microsoft or other large buyers. And let's insure this in kind over multiple years. And what that creates is a situation where the price is guaranteed, and we as an insurance company are guaranteeing the quantity. If the project fails to deliver, our tons are delivered into the offtake instead. Obviously, there's the question of defining the right like-for-like mechanism, but all of these are difficult but surmountable challenges. And now you have a situation where you can look at a project and you have, let's say, 5 years worth of offtake. Those 5 years worth of offtake are now secured. And in most cases, those 5 years worth of offtake, if you've pre-sold, say, 50% of a project's production, is actually enough to buy out the initial equity. And this, let's say, the flywheel this gets going goes far beyond just projects that have offtake agreements, because I'm sure we have a lot of project developers on this call, and you might rightfully be thinking, well, Frederic, thanks a lot. We don't even have offtake yet. What you're saying is very helpful. It's brilliant, but what the heck should I do with it? Because I can't even get my project off the ground without the offtake. And to that very, I would say, very reasonable thought, I would say, what changes the moment that financing becomes available is the financing flow and kind of the trajectory your project can take. And that changes the conversations you can have with investors. Because now you can go to an equity investor and say, look, we need your capital for the initial 5 years that are risky until we get offtake. But then there is a real possibility of refinancing it through debt. So I'm essentially taking your equity for 5 years and not for 15. And that fundamentally changes the kind of discussions you have. And it also fundamentally changes the kinds of IRR you can promise your investors.
Brilliant. Thank you very much for taking us through that. And, what's been exciting to see is that, this template has been talked about for a while and kind of passed around the kind of market circles. But I think 2025 will be the year that we actually see these deals get done. And that's really exciting and a great development for the market. So that was all of my questions for the panelists. I will now have a whole list of questions from you all, the audience. So I would love to jump into those. Frederic, actually, first one is for you. One audience member wanted to know, can insurance play a role in the carrying value of voluntary credits on the balance sheet?
So I'll try to give I'll try to give the kind of answer that EY would give first, and the answer always is it depends, and following that it depends always comes, and I can only encourage you to do so, reaching out to your accountants, to your auditors, and engaging in that conversation, because there's a lot you can learn through it, and we have actually done that. We've actually gone through the process in a regulated setup as an insurer to think about how do we value different carbon assets. And I will give EY a plug here. We really appreciate the advice you've given us thus far, and we've been able to develop a valuation framework in-house with EY's help that we've been able to justify vis-a-vis FINMA, the Swiss insurance and banking regulator. Now, all of that to say, the actual answer is yes, it makes a difference, because any type of discount rate is always trying to capture what is the risk-free rate and what are the risks coming on top of that risk-free rate of the underlying asset that you're looking at. And Jacob gave us a very good overview of all of the risks that projects face, and therefore as investment assets, carbon projects have pretty high discount rates. Now, the more risks you can take out of that, the more you can lower your discount rate. And as an investor who's looking at a net asset value, who has to revalue a portfolio, actually insuring projects can significantly lower the discount rates you apply. And that can be that we're very happy that that is one of the contributions we can actually give to the market to foster more investment and actually help our clients realize more value.
Yeah. JF, Jan, any kind of additional thoughts to bring in here on this question?
Not on my side, Jan.
Okay.
No, not on my side.
Yeah.
Nice
Well, next
framed.
one. Oh. Good. Well, next one for you, Jacob. How do credit buyers like Volkswagen ClimatePartner view carbon project investment returns for the investor, right? Because there's often two parts to this deal. And in particular, what range of return would be deemed kind of quote unquote appropriate?
Oh, okay. Yeah, it's a good question. maybe to echo Frederic a little bit, EY answer, it depends. Yeah, it depends on the project. So I would say what the investor or project developer has to keep in mind is basically what they're offering by putting up the liquidity in lieu of us doing so. And then also generally what the market conditions are. So I would say it depends a little bit on those two factors. So I mean, we would view it as, because we do have liquidity to invest, we would usually be seeking, to the extent possible, lower prices by providing that liquidity to projects as the service that we provide in addition to everything else that we're doing. But of course, because we prefer to preserve liquidity to the extent possible, the preference will always be for payment on delivery to the extent possible. So if another investor comes in is able to do that and enable that de-risking, then it's a valuable service to us. If the price in the end is then market appropriate or at least competitive, and if the project is good. So I wouldn't say there's a specific range. I would say any range could be fine or could be bad. It really depends on the end in the total deal on the table, and then if how it compares to other projects. Then we could pay even a little higher than market price, generally speaking, even though we could provide pre-investments if it does something for us. But then we can also justify, okay, compared to other project investments out there and other offers, this is actually a very competitive deal, and it's a high quality project, and it de-risks our liquidity obligations. Then if they make a high return off of that, we're pretty okay with that. So it just depends on the interaction of those factors, I would say.
Like everything, I think. Oh,
I
please go
would say,
ahead.
Jacob, you're ready to work at EY. I mean, it depends, right? So in my experience, what I've seen is, because it's so niche, when you're talking to institutional investors or specialized asset managers, a conversation that starts below a 20% IRR is very difficult to get anyone excited around.
Got it.
Maybe to add, because we analyze a lot of projects, and to be able to give a holistic solution, we also look at what are the cash flows of projects. I mean, Jacob, you were mentioning liquidity risk actually being a fundamental risk for a lot of projects. I would say the majority of projects are somewhere between 15 and 25% IRRs. 15 on the lower side, a bulk is around 20, and then 25 is probably more in, let's say, more complicated on the political side, jurisdictions where you need a bit more wiggle room.
Yeah, absolutely. But I would say too, and I mean, Jay, I'm curious for your thoughts on this as well, where, especially in the nature-based space, there is so many factors that can actually affect the IRR as well, right? It's nice to have something on a piece of paper, but when it comes to project execution, the question naturally comes up of, especially when you're conducting a larger scale reforestation project of, okay, can you actually deliver on this promise, right?
And I would say there, where we do take on projects, where we do work with a developer, their track record is quintessential. Like one developer we're working with, they've been in the reforestation industry, not from a carbon play that is new to them, but for the last 15 years in very different geographies, such as Africa, Indonesia, Mongolia. And that track record of operational success is extremely important to investors, especially if you're going to do something that has any scale attached to it.
Yeah, absolutely. So one very interesting and relevant question as well, and actually we'll direct this to all of you because I think it can be approached from a bunch of different perspectives, which is that from one audience member, they said it's hard to see how a true market reaches scale without a fungible underlying ton operating at the heart of this market. And they want to hear your perspective of how should we get there? An easy question. Maybe Frederic, we start with you.
Well, I can try. I think there are some nascent effort from large recognized financial institutions to tokenize what we are doing right now and curtail the value chain, which has very large expenses in its current shape, from early on project development to the ability to have the carbon credits on your balance sheet. And I think that's probably going to be a game changer, but the industry needs it if we're ever going to go to any scale and really something that's easily tradable against market participants.
Yeah,
I would say
go ahead, Frederic.
I would say we are at the phase where the market is still in many ways artisanal. And I mean that in the best possible way, as in they're people putting their hearts and souls into projects. And we are learning out of those. We are improving the methodologies we use to measure them. We're improving the financial infrastructure around them to be able to finance them. And we're all working towards making things more fungible. The fungibility is both a prerequisite for scale, but it is also an outcome of a lot of the work that is being put in on the registry side to make methodologies more and more robust, on the rating side to understand things from a third party, on the auditing side to think about how do we audit carbon projects, on the policymaker side, what kind of projects do we allow maybe in our compliance markets, and then also on the banks and insurance side, as in how do we finance this? And over time, we will get there. It's a process, and actually that fungibility is the outcome of having solved many different problems. And as humanity, we've done this before in other things. It used to be that when you went somewhere to buy something and you paid with your gold coin, the baker, whoever you were buying something from, would look at the gold coin and would bite into it to make sure that it's really gold and it's actually the size it's supposed to be, and so on. And we're still in that phase. But then over time, we had a lot of innovation and we worked very hard to build that trust, that integrity, to be able to do these things in a fungible and commoditized way.
Yeah, I think, Frederic, you mentioned a key point here, and that is trust. And with trust is, induced by regulation, viewing carbon as an asset class, legal practices that support the clarity of such a definition, all the other downstream things such as data, market infrastructure, and the likes, and then ultimately getting a more robust assurance process around this.
Yeah. Thank you. Jacob?
Just one more thing. I think it's building off of what everyone's been saying. I mean, for me, it's really, the fungibility is key, but it's built on a compelling use case or series of use cases, which is backed by government regulations, market demand, all of these kinds of things. I think that's what's been really, really tough over the last years also for us in managing all of these ups and downs is what can this actually be used for? I mean, a commodity in the end always has to be used for something, has to have some kind of use value. And there's a lot of, I think, really great, compelling use cases out there. Currently, we don't have very many of them in force, or it's in transition and could be some years away. And I think that's really what's going to unlock everything. The moment we know what it can be used for, whether it's a compliance instrument that can mitigate cost in an ETS, for example, or in lieu of a tax, or even from the voluntary side, just really compelling use cases that will really boost the market, and then the fungibility will be underlying that. And I agree with what Frederic said. It's sort of the outcome of all of those other things working out. But in the end, it relies on other things.
Yeah, I think that's a really important point that hasn't been brought up as much in this discussion today, which is just the absolute necessity of a strong policy signal, and to incorporate this into a regulatory scheme that, like you said, Jacob, makes the case for, well, what am I using this for? Right? Is it to satisfy a compliance obligation or for any other kind of use case on the policy side? So absolutely critical point, and thank you for bringing it up. I see a couple of raised hands. I would just remind audience members, please, if you have a question, put it in the Q&A chat itself, and we'll try our best to get to it. I do have one insurance structuring question, but actually would like to start with you first, Jacob, and then maybe Frederic can turn to you as well. from this question asked, from the buyers or off-takers perspective, is insurance something that the developer should come with in hand, right? Should they say, hey, I've got this credit, it's insured, it's de-risked? Or is it something that the buyer should look to be buying themselves, or the investor? How would you see kind of this insurance structuring as part of an off-take deal really come together?
Yeah, also a good question. I mean, I think maybe we're in a little bit of a unique position because we sort of sit at the intersection of the demand side and the investor side, but then on the other hand, we're not seeking a financial return. So it's a little bit of a unique case for us, I think, at least from our perspective. A developer coming to us and saying, hey, I have insurance already, usually wouldn't really be helpful for us because we have such specific uses for and kind of needs from projects, and usually we're the ones who would be seeking to initiate that based on what we're seeing on the kind of the end buyer side in the Volkswagen Group or for political authorities or whatever the case would be. I would think if you're kind of in trading or looking at international trading of credits across countries, for example, where you have to deal with certain regulatory risks or shortfall risks or things like that, like coming in hand with an insurance policy could be more useful. And I know many people in the market, of course, and I know that many of them are asking for that. I just would say from specifically our case, that's not something we typically seek, and we wouldn't need it.
Yeah. Frederic, how are you seeing kind of insurance being increasingly a part of these deal structures? Who is holding it? Where's the liability resting?
So usually I would look at this from the point of view of what are the real use cases. How is the insurance being used to unlock value? And those are financing that we spoke about in length. They are around equity valuation and the ability to de-risk projects so that you can book better net asset values. But also there's kind of that tipping point of how much risk is your investor willing to take? So insurance, Jacob, you're a very large diversified buyer, so you can take a lot more individual risks because you have that, because you're looking at a broad array of projects. If you now have let's say a smaller sourcing function where you might be sourcing only from a few projects, or if you rely on a few projects for your financial return, the riskiness of the project might just be too high for you to invest. So then insurance can be that catalyst that reduces the risk to a level where, okay, now I'm willing to do it. Jay, if you were outlining this, it's not, risk return is not a function where it's like, okay, if I give you 5% more, are you willing to do it? Sometimes some risks are just too big for people to stomach, and that's where we're seeing insurance stepping in, financing, really de-risking, and also over time being a credible mechanism for reversal and a good addition to and replacement to buffer pools.
Great. Well, we've got 1 more minute left to answer one question that we just got from the audience. Yes, this webinar will be recorded. It will be available on our YouTube channel in a couple of days, but I will end it here. I want to give a huge thank you to all of our panelists. Thank you for bringing your insights and your expertise and your vision. This is a super interesting discussion. Usually we wouldn't think of accounting and insurance to be the thrilling discussion point that it is, but in this case, I think it's an exception. So with that, I will say thank you to our audience, thank you to our panelists again, and have a wonderful day, everyone.
Thank you.